Scott Groves with another mortgage mystery. What is an impound account, or sometimes accidentally referred to as an escrow account? This can be a little bit confusing because lenders, loan officers, title officers, escrow officers, your loan servicer who sends you your mortgage statement, they will frequently interchange these terms of an impound account and an escrow account. Here's the simplest way to explain it. When you buy a home, you are taking out a mortgage against that house, presuming that you can't pay all cash for the house. So you buy a $500,000 house, you put $100,000 down, you're 20%, you get a mortgage for $400,000, and now you will get a mortgage payment every month of a couple $1,000s to pay back that mortgage. Some of it will go to principal, some of it will go to interest. Now, most clients elect to also have an impound or an escrow account attached to their mortgage. So let's say, for example, on that $400,000 mortgage, you owe $2,000 a month in principal and interest. That's normally what the bank would bill you for your monthly mortgage payment. However, if you want to pay your taxes and insurance and have what I would consider a forced savings account, you can have your taxes and insurance rolled into your monthly mortgage payment, and the lender just does a very simple calculation. They take your annual tax liability with the county or the municipality where you live, then they take your annual insurance premium that you have to pay your insurance agent, they add those together, they divide by 12, and let's say in this hypothetical example, your taxes and insurance divided by 12 months would equal $500 a month. The lender will then send you a monthly mortgage statement that has $2,000 for your principal and interest to pay back the loan, an additional $500 for 1/12 of your annual taxes and insurance, and the full bill at the bottom, what actually comes out of your bank account, will be $2,500 a month. And then a couple times a year, whenever taxes are due to your county or city or municipality, or whenever your homeowner's insurance is due every 6 months or 12 months, depending on how that collection cycle works, the lender, on your behalf, with no extra work from you, will send out a lump sum check to pay off your taxes or to pay off your insurance. Now, it's kind of interesting because when you close on a purchase or you close on a refinance, your mortgage is not going to close on the exact date that is 12 months away from when the county collects their taxes. Or your insurance company will actually want their money a little bit in advance, and they might ask the lender for your next year's installment like 11 months from now instead of 12 months from now. So when you get an impound account or an escrow account, it will be very frequent for you to pad that account or put some additional money into that forced savings account up front when you close the loan so that there's a little reserve of money sitting there. This happens, for example, in the county of Los Angeles all the time because they collect their taxes from homeowners in November and April. So if you happen to close your loan in December and your first mortgage payment isn't due until February 1st, you're not going to make enough monthly payments to have enough money in that impound account to send out the taxes to the county on April 15th. So what a lender will do in this hypothetical example where you closed your mortgage in December is they will collect a couple extra months of taxes and insurance up front at the closing. So when the county or your insurance company comes looking for their money, there's plenty of money in that impound account or that forced savings account to pay the entire tax and insurance bill. Now, the good news is every year or so, the lender is going to be required to do what's called an escrow audit or an impound audit or an impound evaluation. And all they're doing there is simply saying, all right, do we have all the numbers correctly? Are the taxes still the taxes? Did they go up? Did they go down? Spoiler alert, taxes usually only go one direction. Did your homeowner's insurance go up or did it go down? Spoiler alert, your insurance usually only goes one direction. And so what you might see from year to year or every couple years is you might see your $2,500 mortgage payment in this example. Remember, $2,000 going towards principal and interest, $500 going towards taxes and insurance. You might see that payment go up to $2,517, $2,524. And that's not because the lender's up to any shenanigans or they're charging you more on the principal and interest of your loan. It's just because maybe the cost of living in that municipality, either with local taxes or with the cost to insure your house, has gone up a little bit. Or conversely, if it looks like the lender has overcharged you and you have too much money sitting in that forced savings impound escrow account, they'll refund some money to you because they're only allowed to keep a certain amount of padding or reserves in that account. So if you're applying for a loan and you have any questions about an impound account, or you're kind of confused about how that cost works up front, give our team a call, shoot us an email, book some time on our Calendly link, or simply leave a comment below on YouTube, and we'll make sure we get in touch with you to explain to you the whole process and see if we can help with your mortgage pre-approval or your refinance. Even if we're not licensed in the state where you're looking to purchase or refinance, we've got a network of loan officers we can refer to. So give us a call. We'd love to help you out. Always appreciate being here as a resource. Scott Groves with the Mortgage Mystery Series.